First of all, the Single Resolutions Board Loan Facility Agreement that we are going to vote on at some point, but which we are discussing today. The headlines around this and the mantra put out is that the taxpayers will be protected from bailing out banks in the future, that the bank's mistakes will not be borne by the public, that under this new system, bondholders rather than taxpayers will be on the hook for losses with the creation of a single resolution board. A special system of rules will prevent a failure from spreading panics across the financial system. So, Ireland contributes 1.8 billion and the fund becomes 55 billion when it's complete. And we have this little nest egg that's going to protect us. This has been presented as a way of defending us from any future bankruptcy or failings of the banks. But in reality, when you look at the figures, just look at the figures for a minute, 55 billion in a fund, it's small fry. This state, and it's a small state relatively speaking, we alone coughed up 64 billion in the last bailout. And you look at then the cost of bailouts elsewhere. In the UK, they bailed out the Royal Bank of Scotland and Lloyds alone to the tune of 133 billion, and the US of A spent 430 billion bailing out the Citigroup. So potentially, the costs of a major bank failing system with a small amount of money like this is a very, very flimsy amount of money indeed, if we for 1 minute believe that it's going to protect us from protect our system from bank failure. Even on its own terms, it won't work. The ECB has been pumping 80 billion into the European financial system every month to try to get the banks to lend. The idea here is that the money to move from the ECB into the banks and on to businesses and households, increasing demand and helping make the economy cover. The reality, however, is that much of the money is ending up in banking speculation as the banks borrow to buy shares and currency and everything that will help improve their bottom line. And if and when another crash comes, 1.8 billion will be quickly swallowed up and the state will be asked to pay out again. Funding this, therefore, sets an extremely dangerous precedent. We should vote to make the banks responsible, and if they don't, it should be the bondholders and the speculators that are hit, not the ordinary taxpayer again. And more importantly, we should be now taking real steps to rein in the banks and the bonus culture that still goes on. I'm also struck by the Government and the Minister's rhetoric about this bill. Is it the fund likely to be ever used? It's just a technical bill. It's very unlikely to be ever used, they say, as now we have the banks well capitalised and etc., etc. Does this sound familiar to the people out there? And I'm sure it does. It's the same rhetoric that we had before the crash, and they told us that such and such a bank, and I won't say its name, was too big to fail, that it would pose a systemic threat to our economy, that the ATMs would close, that the sky would fall in, and is this fund really going to stop the same thing happening again for the same reasons? And won't the government and its ministers be terrified about burning the bondholders and about creditors going on strike and the market sentiment, the whole 9 yards of capitalism, etc., etc.? In reality, the last crash wasn't caused by liquidity or well-capitalised banks, and I don't believe that the next one will, or that the threat of taking 8% of banks' liabilities before they could seek public funds would be much of a protection for taxpayers or for the state. So, here we've been asked to put in place a taxpayer-funded additional insurance scheme for banks, for private banks, for the private sector. That sector, the Minister and his party constantly eulogise as being the engine for growth and for innovation. We can't, of course, do the same thing for our health, for our education, for housing, for transport, for the environment. That, of course, would be subject to strict guidelines and we'd be breaking all the European Union rules. But we can apparently do it for our banks. We're being asked to vote to potentially give more funding over to private banks that make money from speculating and taking risks. The amount is certainly not significant. 1.8 billion would pay for around, is certainly significant, not in banking terms, but in other terms. It would pay for around 70,000 new nurses or teachers. It would open 3 schools or children's hospitals, and it could build up to or more than 10,000 houses. Mick Wallace probably has better figures, probably get more houses out of Mick for the same money than what I'm quoting. Before the crash, the Irish banks were making astronomically profits for some of the wealthiest people in the country. Even during the Celtic Tiger, and this figure is amazing, they made profits of 1 billion per year, an amazing figure altogether. And together with the Irish developers, they effectively had families in a vice grip. and handing out sometimes 110%, 150% billions worth of extra euro into the housing market and helping to fuel even higher housing prices and property prices. But the profits here will remain private, and all that is public is the losses. All that is public are the potential losses, and this bill is yet another part of the process of nationalising losses while ensuring that profits remain private. The project, despite the lessons we have claimed to learn about the crisis, it's the same old story. It's socialism for the rich and capitalism for the rest of us. And I think that brings us to having to look at this venture, that the extent of the crash and the 64 billion that the Irish taxpayers put into the ECB and the EU, how destructive it is to let the banks do their own thing and lend recklessly without a safety net. This is where the single resolution mechanism is supposed to kick in, and the banks being brought under a single system for an orderly wind down in the case of problems. If you put it simply, this is an insurance system for future reckless behaviour, and who is being asked to put up the policy? The taxpayer. The very people who never benefited from the bonus culture and the recklessness in the first place. It's a bit like saying, if a boy racer crashes his car and forced the cost of that crash onto his parents, that would be an awful thing to do. But if they were then told by him that he was going to continue to speed and continue to crash and that they had to put up the insurance premium to meet that, then that would be obscene. And so why are we not making the bankers pay for their own insurance? And more importantly, why are we not enacting legislation now to claw back all of the money that we pumped into the Irish bank system that the taxpayers paid for? I'm not convinced that the culture of banks and how their profits has changed or will change. I'm not convinced that the bonus culture is finished or that caps on bonuses will stay or be around long enough for them not to regain the reward. We know, for example, that the caps on bankers' earnings of $500,000 in pay are still in existence. We know that Richie Boucher of the Bank of Ireland gets $840,000 a year, and we know that there's constant bleating from the banks about the need to reward their staff and to incentivise their entrepreneurs. So I'm not convinced that the culture has changed or that lessons have been learned. Nor am I convinced that the risk of banks failing has gone away. We're told that all of this is to ensure that something like this can never happen again, that we as regulators and the banks have learned our lessons. Really, the banks are even more bigger and more opaque than they ever were, and they continue to trade in very risky and very financially rewarding products, just as they did before the crash. And so derivative trading has become worldwide over 700 trillion. Sometimes the figures are mind-boggling, but listen to that figure, over $700 trillion worldwide in derivative trading, 10 times the size of the actual world's real economy. It stood at 648 trillion in 2011, and it is probably even higher now. According to one report in Forbes magazine, the market has grown so unfathomably vast that a small percentage of contracts went sour. The global economy is at risk of massive damage. So alongside this, we see the growth of shadow banking with vulture funds, a sector that thrives outside of any regulation or any state-sponsored insurance scheme, and that makes up 25 to 39% of the total financial system. And it's really scary to see where these firms are investing and the real estate and the equity that they're buying up around the place. I'm sceptical about the ability of this fund to do what it's claimed to do. And we are sceptical on this side of the House about the right of this fund to be actually used up to shore up profit-making for private institutions. The Irish rich, the Irish very rich, are up to their neck in all of this, and it's obscene that people's representatives, the TDs in here, are being asked to vote to potentially hand over more money of the taxpayers to the reckless banks for reckless behaviour if the economy were to crash again. People before profit want to play a constructive role in this, and we want to socialise banking in the interests of a real economy. And we want all of the money that was diverted away from our schools and our hospitals returned to us by the private bankers. And for this reason, we'll obviously be opposing this bill, Ceann Comhairle. Gur maith agat.